Are annuities a good income source if you don't have a pension?
Are annuities a good income source if you don't have a pension? Okay, well let's break down how you get income out of an annuity, and so we can kind of answer that in different ways. So first of all, one way to get income out of annuity is what's called a systematic withdrawal,
Mm-hmm.
where you just start getting money out of it.
Yeah.
You say, I want, 100 a month or 200 a month or 3% or, whatever it is. And they usually will allow without any penalty up to 10% if you're in the penalty period. So that's not a problem.
Yep.
If you're outside the penalty period, if you have one, then, you can take what you want. And if you're going to do systematic withdrawal, I wouldn't use an annuity for a couple reasons. Number one, you could, if I had money in this taxable account over here, let's just say in some Vanguard funds or ETFs or something, versus this annuity where I can maybe buy even those same kind of Vanguard, funds inside that annuity, or similar ones, then, the ones inside of a regular account, just a brokerage account, we call it a taxable account, it's cheaper.
Yep.
Because the annuity has a lot of internal costs. It's a lot higher, right? So if I'm going to just do a withdrawal, I might as well just do the withdrawal out of the taxable account, because it also comes out anything I have to sell to do those withdrawals as a capital gain.
Mm-hmm.
If I hold on to it for a year, it's a tax advantaged capital gain,
Yep.
right? Long-term capital gain. Whereas anything that comes out of an annuity is ordinary tax, right? So if I'm going to do a systematic withdrawal, right, which has no guarantees, there's just like any other thing, I'm going to look at, a regular taxable account over an annuity. The only advantage of an annuity in that scenario is I can make changes to those accounts, those portfolios. I can buy different Vanguard things or different investments that are involved in those, and without having to account for taxes, versus any changes I make in that taxable account, they're going to have to count. So, but I'd still choose the taxable account. Better taxes, less cost. However, with an annuity, you can get a guaranteed income stream.
Yep.
You cannot get that with anything else outside, with a regular account outside. And so those guaranteed income streams, you can get them for life. You can get them for joint life if you have a significant other. You can get them for periods certain, plus life. So I can say, okay, I want to get this for 20 years or the rest of my life. If I live 25 years, I'll get it for 25 years. If I live 15 years, I'll get it for 15 years, and my beneficiaries will get it for the other 5.
Yep.
And usually with the period certain, if you look at it, you're getting your money back in that time, right? So that's good. So, because one of the problems with a life only is that once you choose that, it's the highest payout of those options. But if you pass away, the money it's gone.
Yeah. Whatever you put in is gone. There's nothing to give to your beneficiaries.
You could give $500,000. When you get a guaranteed income stream for an annuity, your money is what they call annuitized, and it disappears. You don't have it anymore. And so, $500,000 annuitized, you're going to get this payment for life. That's great. You live 2 months, die, well, that's it.
Yep.
Insurance company made out. And so the insurance company is making the bet on how much they can make based on your life expectancy and those types of things. So then it becomes really important. What are your beneficiary situation? Do you have significant other? What's the scenario as to which choice you get? And so if you want to make sure you're getting your principal back, you take one of these period certain, options, and there's different names for that, but they pay less, right? Any more guarantees, you get less income. It can be a good replacement for a pension.
Yeah.
In that regards.
You take yourself out of the market, essentially.
Right. Yeah. And there's some validity to that. Probably the cheapest way to do that is what's called a single premium immediate annuity. They tend to pay better, have less internal costs, those type of things. So you just basically would take that 100,000, 500,000, give it to the insurance company, it immediately disappears, and you get an income stream just like a pension for the rest of your life, or period certain, or whatever it is that you chose as an option. And so that's probably the best way to replace a pension. But if you already have an annuity that is sitting there growing, hopefully, over a period of time, then you have some options. You can annuitize it. You can get an income stream to basically act like a pension. And there's nothing particularly wrong with that. But again, you got to consider potentially your beneficiary situation as to what
and
would
also
work
your
there.
inflation.
Yeah.
If you pensions and some annuities do not have any kind of inflation or cost of living adjustments, and so
Yeah.
you could be falling behind over time too.
Yeah, exactly. That's where the systematic withdrawal has some potential advantage, whether it's an annuity or a taxable account, because you're not the money's not disappearing. It can still grow. If you're going to take it out for 20 years, you could theoretically continue to grow your. I mean, let's say you make an average of 7% a year growth. Uh, you could continue to get 7% more money per year and
Yep.
help you keep up with inflation and still end up with a similar situation in the end. So that's the advantage of systematic withdrawal. There are some variable annuities out there and some variable annuitizations. So there's a lot. I mean, unfortunately, this is a generic question about an issue that has 50,000 answers.
Yeah,
Literally.
every annuity product is unique in its own regard.
Right.
And they set up so every contract's unique, so it can
Yep.
get very confusing very quickly.
Oh, very quickly. You can say, oh, I have a Jackson annuity. Well, that doesn't mean anything because Jackson might have literally over their history 1,000, 2,000 different contracts. And so, we have to look at the contract itself because it is a contract with the insurance company. And your contract might differ from the person that bought an annuity from the same company just a few months later because they changed the contract. And they're constantly making changes. They used to have some pretty good guaranteed income riders. Those got kind of wiped out in the 2008 downturn because they were a really good deal for not such a good deal for the insurance company and a good deal for the consumer. And for those people that had that, they're still out there. They're still guaranteed, but they're not really offering those any longer. So that's just that's how these contracts change based on basically what's happening with the market and whether it's working or not for the insurance company. In the end, I mean, they're not in the business to lose money. They're in the business to make money, and so they're going to make the contracts work for them. However, it's also competitive, so they got to make the contract work well enough for the consumer that they get new money coming in. Yeah. So yeah, it's a good question. But it's hard to answer specifically. It is contract driven, and just be careful with any generic comments on annuities. They can be misleading for you specifically. Yeah.